835-3099. KCAA Radio, the station that leaves no caller or listener behind.
KCAA is your CNBC News affiliate. We're the station that gets down to business.
Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome, everybody. I'm Jeff Barton. I'm your voice in the mortgage industry. 888-713-2929. That's our telephone number. Pick up the phone and give us a call. We are talking mortgages today, and if you're out there and you need a mortgage, give us a call. Or you can email us, info@malibufunding.net. We certainly can be found in a number of different places, KCAA, KMET, KTHO, all of these three great radio stations. I want to say hi and thank you to all of them for helping us out, helping us bring our radio show to the great people in the Inland Empire and up in Northern California and parts of Nevada. We do try to bring great guests to the show. We try to bring information to the show. But more importantly, if we can be of help to you in any way in terms of trying to understand the mortgage business, you will see claims out there. You will see all kinds of pitches. You will see people who say, hey, don't believe that, believe this. Well, you have to do research, and I'm one of these people that believes that unless you're looking or talking to 2 or 3 different professionals in the mortgage industry, you're going with the first person you see, and 80% of the people out there do exactly that. It's against the advice that I think that anybody would give, especially with a mortgage. Let's face it, it's the biggest financial decision you're ever going to make. I know you've heard it. I know you think it. But when it comes down to how lazy are you, yeah, most of us are pretty lazy. I mean, if I'm going to buy a car, I decide before I go to the dealer that I'm going to buy a car. It's just the way it is. If I decide to buy a house, I'm going to buy a house, and that's just the way it is. It doesn't matter whether I get a mortgage from XYZ or TQM. It just doesn't matter. Well, I'm here to tell you that it does matter. You need to find somebody who has flexibility, who has the time to spend with you, who can give you the time-honored tradition of service. We have in our company a fiduciary responsibility to you as the borrower, and my company, the company that works for that I work for, is Malibu Funding, Inc. They're also the sponsor for this show. They have an NMLS number of 79620 for those out there who are needing that information. And their website, by the way, is www.malibufunding.net. It's malibufunding.net. And if you go to malibufunding.net, you will see that there are not only a number of different programs there, but in the About Us section, you will see loan officers. There's probably about 40 of them in there. And if you contact any of these people, I'm sure you will get terrific response. Customer service is the only way that small business stays in business. They are not Rocket Mortgage. They are not Quicken Loans. They are not Chase. They are not Bank of America, Wells Fargo. None of these larger institutions. You got to go to them. If you want a loan, and by the way, they usually get most of their business from portfolios that they've already established. And for those out there who are thinking, what is a portfolio? Let's say I'm Bank of America, and I just did 500,000 loans last year. Most of those loans I will keep and service myself. A vast majority of them I will send off to Fannie and Freddie, but I will service the loans. I will, send out the mortgage statements, and you will send out the mortgage bill, and you will send them back to me. That is a portfolio of loans. If you have loans that you keep in your pipe, i.e., you don't sell them to Fannie and Freddie, yeah, that's what we call a portfolio loan. Now, there's a lot of lenders out there who do portfolio loans, but let's say you are that type of person. If you're in the refinance, and I'm the guy, and I'm with Bank of America, and they're holding my loan, and I want to refinance with a different company because I want to take either money out of my house, or I want to lower my rate and term of my loan, or I want to go to an interest only, whatever the case may be. Those particular notices or the request for the demand of how much you owe on your loan goes right to Bank of America. And those people will pick that up and go, ha, someone's trying to get out of a Bank of America loan, and they will call you on the phone. So that happens all the time in portfolio products. If you're with a company like Malibu, who does not portfolio loans, who funds loans, but does not portfolio the loans, meaning they don't service the loans, they don't hold the paper. They immediately sell them off. So there is no incentive for them to be able to continue to grind you or circle back and hit you again, or come at you as if somehow, if you want a different kind of loan from a different kind of product, hey, why don't you use us again? So if you're out there and you're listening to the show and you're thinking about getting a mortgage, shop around a little bit. Good thing about Malibu Funding, good thing about a lot of mortgage bankers, mortgage lenders, mortgage brokers, is that they deal with dozens of companies, dozens of different lenders that can offer you many different types of loans, whether it's, as I said, interest only, whether it's a ARM product, a 5-1, a 7-1, a 10-1. And by the way, we have a guy coming up on the show later on today who's going to talk a little bit about interest-only loans, which I think is a terrific product if you are an investor. If you're an investor out there and you're only looking for a loan for maybe 3-4 years, by the way, that 4-year window has been up from a 2-year window in terms of escaping the short-term capital gains. Check with your accountant, but making sure that you can keep all the money rather than have the tax person come in and take it away from you. It is a 4-year window now, so you're going to need a longer-term loan. The interest-only product, the ARM product, these are all terrific products for you to be able to utilize if, in fact, you need that type of product on your investment. Let's talk rates a little bit here. Oh, first thing I want to talk about is the under 35 homeownership rate rising fastest. Okay, what does this mean? We have 3 blocks in this country of homeowners, right? We have the baby boomers, which I'm a member of, born in 1945 to 65. Then we have the Gen Xers, 65 to 85, and then 85 to 2000 are the millennials. Now, under 35, so we're talking millennials here, home ownership rate rising fastest. Now, we've talked about the millennials as the greatest group of borrowers out there, the greatest homeowner section, but their home ownership rate is really not that high. So what we're seeing now is, and I'll read this from Jan Swanson, thank you, Jan, once again, article about the home ownership rate, and she says the rate was lowest in the West at 59%. Now we're talking about 59% of homeowners who are under 35 owning homes. That's really low. We are looking at a national, let's say the Caucasian group in the millennials is 73%. If you're looking at the rate overall in different sections of the country, 59% in the West, which is not great. Largest gain of any region, rising almost a point to 61.3%, is the Northeast. Let's see. There are other demographics in this that I think are important. We look to African Americans, we look to Hispanics to be larger blocks of homeowners. Although, and I don't know where the problem exists, but HMDA, HMDA, which is the Home Mortgage Disclosure Act, is going to now start tracking at the end of 2018. I'm 100% against it, just simply because it drives cost up. And I can't have more costs because we don't have enough loans to pay for what we're doing now. But regardless, HMDA is trying to figure out why homeownership rates are lower for minorities, the Hispanic community, the African American community, although even the Asian community is less than the Caucasian community. Why that is. It isn't necessarily based on region. It's not based on other demographics, i.e. education, what your job is, certain things that would normally take this and say, oh yeah, that makes sense. No, this doesn't make sense. So we're trying to see if there's some redlining going on, i.e. interest rates for certain minorities are higher in certain sections of the country than other sections of the country for whites. And as a direct result of this type of collection of information, a lot of different regulations are going to come into play, which is going to drive costs up. Obviously, the cost of lending keeps going up. And when we get into HMDA regulations or we get into the demographic under 35 homeownership rates rising, what we're talking about here is a mere 2 or 3%. We're not talking about the same percentage as it would be for, baby boomers, white baby boomers, which I happen to be a member of, which 73% of them own their own homes. So when we talk real estate, when we talk mortgage lending, what we're trying to do is improve the overall look of those particular groups who have not had, I guess, either the opportunity or have not yet bought into home ownership. Home ownership is the number one way to wealth building. Anybody out there that tells you different is wrong. Now, in this market, we are seeing people take money out of their house and then invest it into investment properties in order to get long-term residual income. Again, if you're thinking of taking money out of your house, the good idea is to make sure you're shopping around, make sure you're checking programs, rates. Obviously, anybody who's thinking of doing that, please give us a call. But certainly, if you're listening to the show, you will have a couple of different lenders on today. Call them too. Make sure you're getting a different rate, different criteria for the loan, whether you're a QM or non-QM person. Anyway, I'm Jeff Barton, your voice in the mortgage industry. Really glad you're listening to the show today, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's our telephone number. If you pick up the phone and give us a call, we can talk to you about your mortgage. And guess what? It is summertime. A lot of things happening in the mortgage marketplace right now. Actually, we've seen a bit of stabilization of rates, a little bit of actually come down. There's a lot of long-term effects about what's going on both in the real estate market as well as the bond market. We've seen GDP grow up to 4% in the second quarter of this year. That came out just last week. So a lot of things that are interesting in the economy which are affecting the housing market and also what's going on in the mortgage market. I'm Jeff Barton. Thanks for tuning in. If you'd like to email us, info@malibufunding.net is our email address. I'd like to say hey to everybody at KCAA, KMET, and K-Tahoe, all our great affiliates who bring the show to you each and every week. San Bernardino, Riverside, Tahoe, hello. How's everybody doing on this nice, hot, warm day? Stay cool and stay hydrated. We're going to get into a little bit of how to do house showings a little bit later in the show. But off the top, I brought to the show today another great expert who's going to tell us something about what his company is doing in order to solve some of the issues of people trying to get a mortgage who may not be qualified for one type of mortgage or may be able to help you in another area. It's Richard Gage from Priority Financial. And Richard, first time on the show. Thanks for doing this. How are you?
I'm just fine, Jeff. Thank you for having me.
Thank you very much. Okay, tell us a little bit about Priority Financial. I think we've years ago had another rep from your company on, but give us an idea of what you guys do, what you specialize in, how you're out there helping the public.
Priority Financial is the largest non-QM mortgage lender in the U.S. Non-QM is qualified mortgage. So qualified mortgages are your less risky 43% DTI full documentation loans. The U.S. government set those up in 2014. The other ones, alternative documentation loans, 12 and 24-month bank statements to qualify your income, higher debt-to-income ratios,
right.
Interest-only loans. We do those. We try to satisfy the market in that area more often than not.
You know, so we get a ton of calls for that interest-only program, and knowing that you guys have that, give us your highlights on the program itself. It's obviously an ARM product. Give us some of the degrees of difficulty in order to get that kind of loan, and then tell us what it is.
You can qualify either way. You can do a qualified mortgage or a non-QM mortgage, and you can get the non-QM for interest only.
Right.
On it, you can get an interest only with a FICO score as low as a 660. You can get a 5-1 or 7-1 or 10-1 ARM for the interest only. rates are ranging from 4.5 to 5.5, 6.
Oh, that's pretty good.
On how you qualify?
Yeah, that's pretty good rate for that.
Yeah, and then you're only paying interest for 10 years, and then the remainder, if it's a 30-year, you're paying interest only for 10.
Right.
The remaining 20 years is fixed.
Right, exactly. It's fixed the remaining 20 years. What's the rate? What's the cap? What's the index? All that kind of stuff?
It's Jeff, it depends. At that time, wherever rates are, it's indexed according to where rates have moved in 10 years at that point. They can only go up 2% per year once it's indexed at that time. And then, of course, during the period for interest only for the first 10 years, it just depends on whatever you establish for 5, 7, or 10 years.
Okay, excellent. No, well, that's very interesting. Do you find a lot of people going to that just because they like the lower payment?
Yes, more and more. As a matter of fact, the one area that's growing the most for new loans is that non-QM, and a lot of those are interest only, just to lower your monthly payments. Get into the same loan but have a lower payment.
Right. Do you find that a lot of these customers are looking to either flip the property within the first 4 or 5 years, or do you think most of them are looking to hold long-term and to refi?
I'm not seeing, as popular as it is on TV, I'm not seeing the flipping going on as much with those interest-onlys. And I'm glad you asked that, too, because it's being used for investment property a great deal. So you can buy the investment property, I want to mention something else, and do it with what's called a DSCR. Use the income from the property to qualify, to help you qualify to get into the loan to purchase the property. So you can do that as well and do that interest only. So we're seeing a lot more of that.
Yeah, we're talking to Richard Gage from Priority Financial, and we're talking about an interest-only product. They were big back in the day before the crash. There were a lot of people using them, and I think they were really using them as a way by which they could get the lowest possible payment through kind of signature loans. That doesn't exist anymore. So what you're looking for now is some skin in the game. How do you guys feel about your particular product versus some other companies that are out there doing something similar?
We're very rate competitive, and we're a little more lenient as far as who will allow in. So you can qualify using alternative documentation for your income, but still get the interest only. And we're very competitive in that regard, trying to push the boundaries a little bit on what you can qualify with.
Give us an example of some of the documentation. Are you talking about just like CPA letters, or you're talking about just bank statements only? What are you looking at in terms of the income documentation?
You can do, Jeff, you can do either a 12-month bank statement or a 24-month bank statement program, and you produce your bank statements, personal or business, one or the other, for 12 months or 24 months. Better rate if you do 24 months on top of it. And then you also supply, and in our case, an unaudited a P&L, a profit law, an unaudited profit law. So it doesn't have to come from your CPA to help qualify. So we can look at what losses you've been taking along with the deposits that you've been making into your account. That's how we establish it.
And do you guys hold on to all your own paper when you do the loan, or do you sell them off? And the only reason I ask that is obviously the risk to whoever the end investor is based on whatever the matrix you're using in order to do the loan. A lot of companies do hold on to the paper. I just don't know if you guys do.
We hold on to a lot of our paper. We sell off about half. We hold on to about half on top of it. And again, you know, when we're doing a qualified mortgage, you can sell it to Fannie Freddie, and they'll pick it up, Fannie Mae, Freddie Mac, and they'll pick up the loan, they'll purchase it on it. And for the non-QM, we hold on to a lot of those loans, and of course we assume the risk because of it. But that's how we do it. So some are sold, and then some we retain and then service.
Now, do you, in different parts of the country, Malibu Funding, who's the sponsor of this show and who I work for, also, they have offices in like 10 different states. So if you're here in California, let's say, and you wanted to have a income property in Nevada or out in Florida or Texas or something like that, could you guys do that too?
Yes, we do. We're licensed to do business in about 23 states.
Okay.
So as long as we have our license as a company in Texas, Nevada, California, like Malibu Funding, to a great extent, New York,
Right.
Illinois, Florida, then we can do the loan from here, but we can do it there.
Of course, yeah. New York, how is that doing business there? I've always thought about doing business out in New York, but always thought that the bureaucracy there would make it really difficult for an out-of-state company. Is it?
It is a little trickier to do it. Chicago's like that as well.
Right.
So you have to know some of the ins and outs of that market. But there's such big markets for business. Nothing's as big as California, obviously, but they're very big, and to me it's worth it to kind of know some of the regulations, some of the nuances, so you can do it there.
Hey, could you shout out your phone number quickly? We got about 30 seconds left, so if people want to get a hold of you who can't see the video feed, they can.
214-794-6292.
Great, Richard. Thank you very much. I really appreciate you coming on the show and giving us this great information.
Thank you, Jeff. Thanks for having me.
Absolutely. And that's Richard Gage from Priority Financial. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, 888-713-2929. That's our telephone number here. Please pick up the phone and give us a call. Why? Because you probably need some questions answered about your mortgage, your real estate deal. What's going sideways? How come it isn't closing? Why can't I get a loan? All of these are very legitimate questions, and you know what? We have some answers. We may not have all the answers, but we certainly have some answers for you, especially if you're in the beginning phase trying to figure out who you're going to work with. We have a great step-by-step plan by which you go out and interview some people. Anyway, give us a call if you'd like to email us, info@malibufunding.net. My Twitter handle is @Jeff6493. You can see us on YouTube, and also themortgagevoice.com has all of these shows, as well as the Las Vegas Real Estate Show that we shoot for television, both of these shows on air. KMET, KCAA, and K-Tahoe are the three great radio stations that carry the radio feed, which also have the video component to it as well. We do bring great guests to the show who have answers, who have experience in the field, and from Real Estate Mortgage Network, REMN, again, another terrific guy, Brian Hewitt, been on the show many times. Brian, how are you?
I'm doing very well, Jeff. How you doing?
I'm well, too. Thank you very much. We were talking just briefly off air about buying into equity on some of the programs that you've talked about. Just give us a little recap of what, because it was such a great story. I wanted to save it for on air.
Okay. Well, yeah, definitely. I mean, as a consumer and a listener, I would grab a piece of paper, because I'll go into a little more detail a little bit later in this, but the home style renovation and the FHA 203Ks, where people are buying the worst house in a good neighborhood,
right?
They're walking into instant equity. And to give you an idea of the significance of this, when people are looking to maybe move up, and they're already a homeowner, they're looking to maybe move up to a nicer house, they're finding out that they might be priced out in certain communities.
Right.
But they can do a renovation or a remodel of their house at significantly less. I've run into situations where a consumer may say, "Okay, I can renovate my house or remodel it for $100,000," and that might seem like a lot. There are companies out there that will do a consumer loan for $55,000 of it, but then you need to come up with the other $45,000.
Right.
The interesting thing is a $55,000 consumer loan has an average monthly payment of over $900.
Well,
it's
about an 18% loan.
No, actually, because of the way it's structured. Here's the interesting thing: we looked at a company that does remodel loans. They're
right.
a unsecured signature loans from a consumer, their rate varies from 4.99 to 24.99.
Right.
And they have written $3.6 billion in these types of consumer loans.
Wow.
We wanted to compare it to the difference of doing a mortgage versus doing the consumer loan.
Right.
So at a 5.25% interest rate, the consumer loan is over $900. It's almost $1,000 a month. He's on a $55,000 loan.
Right.
The same thing in a mortgage is less than $300.
Right. And that would be the difference on a 203K?
That would be the difference of doing a consumer loan where you're just signing paperwork versus actually doing a mortgage, whether it be a 203K or a home style.
Right.
Okay. So this company has made a tremendous amount of money. I'm not going to name them, but it's not the most advantageous financing for a consumer. If you have the ability to replace your bathroom and all your kitchen and all your bathrooms,
right,
but it's going to cost you $300 a month or $900 a month, I mean, the math tells you which one you would probably pick.
Well, tell me now, the one that is the home style or the 203K, they require the refinance of the first mortgage, right, with the additional amount of money tacked on. So the overall mortgage that the consumer currently has really depends on what the blended rate will be for the new loan versus what they're paying on the old loan, right?
Okay, yes, that is true. So I'll give you an example. If you were, let's say currently you had an interest rate you were able to refi towards the lower side of the market, and you were at, on an FHA loan, 3.5.
Right.
On a conventional loan, you were at 4.25.
Okay.
You're realistically looking at an interest rate potentially a half higher, maybe even 3/4 higher.
Right.
But you're also talking about a larger loan balance. So yes, your house payment is going to go up. So for about between $50,000 to $100,000, your house payment will go up $300 to $400.
Okay.
Now that's if you do any type of renovation loan as a mortgage. Now, if you don't do it as a mortgage and you do it as a consumer loan, $50,000 will cost you $900 a month.
On top of your mortgage that you're already paying at 3.5% or 4.25%. Right.
Correct.
Right.
Yeah. So the thing is that a consumer may go to a contractor or may go to like a design and build type contractor where they have everything in place, and they're looking at the easy route. Now, of course, everybody knows a mortgage is a little bit harder to go through. But if you're going to save me $600 a month, I think I might take the extra month and go the harder route.
Absolutely. Now, when you tack these loans, not that tacking these loans, but I mean, the consumer loan is like another loan, whereas the 203K or the home style is just one loan.
It's just one loan, and the interesting thing is it's considered rate and term because the money goes into the house, not into the consumer's pocket.
Right.
And in most cases, the interest is tax deductible. Now, of course, that's changing a little bit. But
isn't the appraisal also an issue in terms of how they're appraising the property? Tell us about how they're appraising the property.
So that's the great thing.
Right.
The property is appraised as a completed project. So today you have a house that you bought 5 or 6 years ago, or maybe you're looking to purchase a house that has never been updated.
Right.
They're going to consider that house in the appraisal world. They have a structure of levels, like 1 through 5. 1 is a brand new house, nobody's ever lived in it, and 5 is a house that nobody's lived in for the last 10 years and it's in a state of decay.
Right. This is a house that needs help. Right. I know those houses.
Yeah. So what happens is if you buy a house, and let's say it's a 4 level.
Right.
But you renovate your house or remodel your house, you put all new kitchen, all new bathrooms in it, all of a sudden you're a status 2 versus a status 4.
Right.
You gain instant equity that way. So when the appraiser looks at the contractor's paperwork, he'll come up with a value. So, for example, if somebody bought a house for $400,000, but it was a 4 versus a 2, and they do a renovation that would bring it to a 2, that $400,000 may be worth $500,000, depending where you live.
Now, in describing the house, square footage, lot size, and location, they really use the comps in general. So you're saying that because of the fact that this is a renovation, it's almost like you're, getting a new house, that you can go beyond the 15% variance that they usually look at, even in the worst or the best neighborhoods?
Oh, yes. Yeah, tremendously. I'll give you an example. I sent out a set of docs today for a consumer who purchased a home.
Right.
And it's in a very nice neighborhood in Northern California, and the house literally was probably the worst house in the neighborhood. I'm surprised the association allowed them to get to that point.
Right.
They bought this house in a neighborhood where most of the houses are over $800,000.
Wow.
They were able to buy this house for $420,000. Their renovation costs were $120,000.
Right.
We build a contingency reserve in case there's any surprises during the renovation.
Of course.
So we built an $18,000 contingency reserve. The consumer is not going to be able to live in this house through the construction for the first 5 or 6 months.
Right.
So we even built $24,000 worth of house payments while they're not living in the house into the loan, so that they can make just their rent payment and not have a rent and a house payment.
Right. We got about 30 seconds.
Okay. Well, let me run through this real quick then.
Right.
Their total cost was $618,000.
Right.
They put down $22,000. Their loan was $573,000.
Right.
Their after approved value was $878,000. When the work's done, their equity is $305,000.
Wow. That is unbelievable. You got any of those houses left? It sounds like
I don't know. I normally see equity gains at 100 to 150.
Yeah, that's
This
300,000.
one is extreme.
Brian, thank you very much. This is a great program. Shout out your phone number quickly for anybody who wants to get more information about this particular program from you directly.
Certainly. It's Brian Hewitt at 949-529-7366.
Thank you very much. And Brian, I will want to get you on again to continue the discussion about these two terrific programs. Thanks very much.
All right. Thank you, Jeff.
Thank you very much. That's Brian Hewitt from REMN, a Real Estate Mortgage Network, and I'm Jeff Barton, your host in the Mortgage Voice, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, 888-713-2929. That's a telephone number. Pick up the phone, give us a call. We're going to talk mortgages today. We're going to talk hard programs. We're going to look at way you spend your money in terms of investing in real estate. How are you doing it? And what are you going to do if you have a problem? Let's say you're a person who is working. Okay, that's the first step you got to have. You got to have a job, but you work for yourself. And you're thinking, okay, I don't pay myself. I basically run my own business, and I run everything through my business accounts, and so therefore I'm writing off my rent that I currently pay. I want to buy a house, but I'm renting, so I write off my rent for my business. I have a car that I lease, and I'm writing that off as well, and there are numerous other write-offs on my business, so my taxes at the end of the year show me making less than $30,000 when really I'm running $100,000 a month through the business. Okay, there are a lot of people like that out there, and if you're one of them, I totally understand it. About a year and a half ago, a lot of companies came out with what they call non-QM products. We've had a couple of people, and we'll have on the show today, talking about QM, and the expansion of the non-QM space has really grown rapidly for the last 1.5 to 2.5 years. The reason is that the Fannie Mae and the Ginnie Mae and the Freddie Macs and the Sallie Mae of the world make it a little bit more difficult in order for conventional loans to be bought and sold. So they have a very strict guideline that you have to, as a lender, adhere to in order to lend money to certain types of people. Well, in the non-QM space, there's none of that, because the government agencies or the GSEs do not purchase any of these type of loans. So, for instance, if you're one of these people I just described and you want to get a loan and you find a company in the non-QM space to give you that loan, let's say you want to buy a $500,000 house and you have to have, let's say 20% equity in, so that, because the math's easier, and you want a $400,000 loan in the non-QM space. Well, those loans that they make to you are not sold to government, to GSEs, right? Fannie Mae, Freddie Mac, they're not buying them. Ginnie Mae, they're not buying them. So these are all private sector loans. And as the QM space or the non-QM space grows, private sector funding of loans also grows, which is a good thing. We are seeing a very good economy right now, something that we've probably not seen for, well, they say since 2014, but let's say we can sustain above 3% GDP for the next year, which is a good point to a 1.2% higher than anything during the last couple of years of the President Obama's administration. So if you're in that world and you're a lender, you're thinking, okay, this is a good economy. It looks like property values are going to be sustained and maybe even grow anywhere from 6 to 10% per year. This is a good market to be in. So that's why you're seeing a lot of a plethora, I wanted to say, which I don't like the word, but it's the only word I can think of at the moment. So you're seeing a lot of lenders in the QM space because they can fund these type of loans. They can hold on to the paper or find an institutional or a foreign sovereign or somebody else, insurance fund, somebody else to pick up large groups of these particular types of loans and hold on to them and service them. So that's why there's more and more of these loans out there. Private sector being what it is, in an up market, in a market that the GDP is growing, yes, this is the time to get these type of loans. And by the way, in the non-QM space, now we're looking at rates in the, let's talk about rates for a second here. The 30-year rates right now in conventional FHA, VA, and USDA, all the government, the GSEs that buy these loans, the rates are anywhere from let's say 4.6 to 4.9% in that range, right? Which is pretty good. I mean, it's still below 5%. And by the way, I just paid off my house. I had a 15-year loan, and my loan was 5.125%. And that was all through all the years of, high 2%, high 3%. And now we're into the almost back to where I had my 15-year loan. I didn't obviously refinance at the time because I was too far along in the loan payments to make it up in the last remaining 5 or 6 years of the loan. But for those of you out there who have loans in the, I guess, in the conventional space and are sold to Ginnie, Freddie, and Fannie, and are looking at perhaps getting money out of your home, and maybe you've had a change in circumstance for your employment. Maybe you were a W-2 person, and now, you're opening up your own business. There's a lot of businesses opening up, and you go down to Riverside, drive along Riverside Drive, you go out to San Bernardino, you go along the 15, you go up to Hesperia, to Hemet, to Paris, a lot, Adelanto, a lot of spaces, a lot of places that I'm talking about. A lot of local businesses have opened up in the last 2 or 3 years. So if you were one of these people that said, you know what, darn it, I'm going to go out there and I'm going to start my own business. This is, the American dream. I'm going to be my own boss. And you've switched yourself from a W-2 type person, which is, of course, the QM loan person, into the entrepreneurial person who's making money but who doesn't report it all in your taxes, but who has bank statements to support what your income really is based on the cash flow going through your business. Now you're the non-QM person. Well, the rates between what they are now and what Brian Hewitt was talking about earlier it's really only a half, 3/4 to a point different. So really, what is the benefit then of sticking with a GSE or sticking with a QM product? those products by which are bought and sold with Fannie and Freddie. If you've got more flexibility in going into a non-QM product, either with, let's just name a few of these companies. We've got Priority Financial Network, Angel Oak, Citadel, what's a couple of, Athos Capital, certainly. Some of these companies require that you have a non-owner occupied. Some of them require that if you hold title. Oh, and by the way, I was out in Las Vegas. We were doing the television show out there, the Las Vegas Real Estate Show. Ran into a guy at a mixer. I belong to this group called the Outback. The Outback is an investor, Outback, R-E-I-N, Outback Real Estate Investment Network. Now, that particular group, and there's tons of them, and then you can go to Facebook or any social networking group and find many of these type of companies out there, and networking groups. So Outback, R-E-I-N, which is a real estate investor, or you want to lend money through a real estate investment network. The best thing to do is to have the property purchased in a trust, meaning that when the person wants to do the loan, you want to loan out or you want to get a loan, rather than go through the process of trying to go to a recorded deed on the property through the loan, have escrow go in to do that, have the foreclosure process be cumbersome, you might be able to get a better break on the note rate if you go through a trust, i.e. the property is held in trust. The buyer is the beneficiary of the trust, and through the operating agreement that you and the lender have within that trust, both can be protected, and in the event of a default, there isn't a long process by which the seller, or not the seller, but the lender on the property doesn't have to go through. But they may be able to give you a lower note rate, so that gap between 0.75% and 1% to the non-QM space may be able to shrink down to 0.5%. Now, nobody's going to default on a property they have equity in. Let's face it. If you're out there right now and you're thinking of going into either a hard money loan or some other type of non-QM loan where you can use this type of vehicle, and by the way, it was called, it was out in Vegas, I forget the name of the company, but it was through another company called For Sale by Owner Vault, FSBO Vault, which is something else I'm going to get to in a different segment of the show. But these type of vehicles can be used in order to lower the rate on the loan, because the risk to the lender is less, because there's not this long procedure in order to foreclose on the property if in fact you default, which you're not going to, because in a market like we have right now, where we have ascending values, we have market values going up 6 to 10% per year depending on what market you're in, although we have seen some softening. I want to get to that in our next segment. There has been some flattening and softening, and what we have is long-term prognostications on, one, what's going to happen in 18 months to 2 years, meaning 2020. What's going to happen to the economy? What's going to happen to the real estate market? And two, where are rates going? We are predicting that we're going to have another couple rate rises this year. So if that's true, where will actual mortgage rates be? And they are tied to the bond market, which of course is tied to the yield and also the economy and the GDP. So there's a lot of things going in that. But to get that answer, stay tuned for the next section. If you're looking for the non-QM loan, which I think is a great product for a lot of people, especially those of you out there who are looking to buy and hold for a certain period of time. Brian Hewitt over at Remen talking about the interest-only loan, which I love the product. If you're an investor and you're thinking about getting into a loan and you only want to own the property between 5 and 7 years, which is probably maximum time that you need to stay in the property. And everyone remembers now that we are 4 years, not 2 years, in terms of escaping any short-term capital gains. That was changed this year in the tax bill. It used to be that every 2 years you could sell a property that you just bought and not pay capital gains tax, short-term capital gains. Well, that's not the case anymore. Check with your particular accountant before you bank on what I'm saying, but that's something to be aware of. Anyway, we'll be right back. My name is Jeff Barton. I am your voice in the mortgage industry. Thanks for tuning in.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, 888-713-2929. That's the telephone number. Pick up the phone and give us a call. We talk mortgages. If you'd like to see us online, go to themortgagevoice.com. My Twitter handle is @Jeff6493. Email is info@malibufunding.net. If you have a question and you just don't want to pick up the phone, email us. You can tweet at me. Anything you want to do in order to get your questions answered, we will be happy to do so. We try to bring to the show all the questions and answers and everything else that has to do with mortgages, but obviously we don't know everything. So if we don't have the answers, we're going to try to get you the answers by sending you to the correct person. We bring people on the show, as I said, who aren't from Malibu Funding, and that's the company that sponsors the show and also that I work for. So, yeah. All those things being equal, let's get to the rates. One of the interesting things about rates this week is we've seen kind of a slowdown in the rise in rates, although we're anticipating the Fed to raise rates a couple more times by the end of the year, and that would be, of course, affecting your credit card, your car loan. But as an ancillary aspect of that, we usually see mortgage rates rise consummately at the same rate that does. So 30-year fixed rate right now is anywhere from 4.625 to 4.75%. The FHA rate, VA rate, 4.25 to 4.5%, and the 15-year fixed at 4.125%, and the ARM products. Again, those ARM products for people who are out there in the investment community who are looking for a short-term loan at the lowest possible payment. Those 5/1 ARMs are at 3.75% to 4.25%, and the mortgage rates themselves have stayed steady. So we're talking about what is going to happen in both the mortgage interest rates, which I just talked about, but also in the real estate market. I've been reading recently that we're looking at 2020, according to some, that we'll see a recession of sorts. And I don't know what form it's going to be, but obviously the economy being and doing as well as it has been and on the rise, particularly in the last quarter, we saw 4% GDP, which the president was rightfully so touting as one of the accomplishments of his administration. I think, according to this article, and again, I don't know these articles, whether there's political spin, because everything is now called into question. But according to the article, it was talking about how the stimulus package, which was obviously the tax cut to businesses, is really what's happened in terms of making the economy grow at such a pace. We've had durable goods orders increase. We've had spending by companies increase. We're seeing a lot of repatriation of money, and all that money gets spent. So maybe that's one of the reasons why we have a GDP of 4%, 4.1% as a matter of fact. But we also have consumer sentiment, which has been up, which I think is an indication that people feel pretty good about their job, what they're doing, although if you're in California right now, and in some parts of the West, your state is on fire. My state is on fire, and it's burning, burning, burning. And anybody who's out there is listening who's got obviously issues with that, I'm really sorry. I know what that is. I know the stress of it. I know the stress of weather-related issues. And in the Inland Empire, in San Bernardino, Riverside, there are pockets that are burning right now, and I feel bad. Certainly up in the Tahoe area. I was there a week ago today, and the South Lake Tahoe area was on fire, and the sky was burning. I was up there doing a race. I think I talked about it a little bit earlier in different shows. Yeah, it was tough because you could just see the fire embers burning and falling on things and just waiting for the combustibility to happen. And it's tough to see. And we're seeing thousands of homes threatened, hundreds of homes lost. Yeah, it's not an easy thing. And right here where the studio is, and Daryl can speak to this too, last year's fire was not only scary, but took a lot of houses in the area.
Yeah, it was tough all the way around, especially this community. It started in Fillmore, which is literally 30 miles away.
Right.
And to think that it could get from Fillmore to the sea to Ventura and up to that's the one that ultimately hurt Montecito and Santa Barbara area. To imagine that was possible is
well, the temperatures
crazy.
The temperatures don't help. I mean, if we're looking at triple digits, I was in Las Vegas earlier in the week, 117, which I've never been in 117. It was unbelievable.
A good friend of the radio family here, Timmy, had moved away, and he's up in Redding. And he's
Right.
sending me a map every day. It's getting closer and closer, and it's 100-degree plus weather up there. And
Redding's, they're having a tough time up there. I clicked on 114 pictures today of the fires around the state and a neighboring state in Nevada. It was frightening. Some dramatic photos. The heroism and the way that firefighters just jump into this. I don't know if I could ever do a job like that. You?
I don't think so.
No, I just, I mean,
no matter how heroic you would think that you would be under any circumstances, I mean, just the heat and the smoke.
The heat.
I mean, I've had heat stroke a couple of times, and fortunately for me, it's been, on the golf course. It's certainly not out fighting fires.
Right, exactly. I think those people, it's just amazing, and they jump into it. I shared a plane ride with a guy a week or so ago, and he was a replacement firefighter. I think we talked about it on air last week, and he was going into the fire to be a replacement. He was a contract firefighter, which I guess the BLM uses all the time, but just really, I mean, I don't think that you can say enough about those type of people who goes into those situations. I feel bad for the people who are in the listening area, who are in the fire zones. Stay obviously as cool as possible and stay safe. Right?
Yeah, as of today, we've lost a couple of firefighters in the Yosemite area.
Yeah, I've read that as well.
Yosemite's closed today.
Yeah, Yosemite is closed, and I'm supposed to go up there in September, but I don't know. With this type of weather, I don't see any break. And it's, oddly enough, it's really humid, which is unusual, although out in Vegas it was 9% humidity, so it wasn't humid there.
It's that dry heat.
It's that, exactly. On that same front, but not as serious, is, okay, you're out there, you're a real estate agent, and you have people that are in your car, or they're driving behind you, and it's 110 degrees out, and you've got them on showing 5 to 6 properties. The tips to having your clients stay cool, what are they? There are 5 tips, and I'm going to ask Daryl and to kick in the music, and although there is no music, but
hydrate.
Okay, right. The number one thing to staying cool is hydrate, and to make sure that when you're out there and showing properties, because believe it or not, when you go from air-conditioned car to 110 degree heat or 100 degree heat into an air conditioning house and then do the reverse back to the car, the amount of liquid that you lose just by talking and breathing is unbelievable. You don't notice it because it's so dry, you're not sweating, but you are sweating. So hydrate, hydrate, hydrate. What's number 2 on that list?
With that in mind, I can't think of any of the other ones. But,
okay, here's a tip for you. If you are seeing a house and you are driving there, and you're either with your agent or your agent's in the next car, have somebody stay in the car and keep the air conditioning on. The less time you spend in that heat, the better. And if you come out of a house after a half-hour showing and you have to wait for your car to be able to cool down again, that in and of itself is a way to get overheated. So if you have someone in the car and they keep the air conditioning on with the engine on, obviously, this is tip number 2 for you.
Yeah, the real estate agent that says, "Oh yeah, the air conditioning just stopped working yesterday."
Exactly.
Yeah, don't get in the car.
In that car. No, exactly. Okay, number 3 on the list is
have some cucumber water waiting in the place.
Yes, if you get into a house and they, God forbid or heaven forbid, they have no air conditioning in the house, get out of that house as quickly as possible. Do not stand in a house at 110 degrees without air conditioning. Remember, you can always come back when it's cooler, but you cannot recover from, because the only thing you're going to remember from a house that you passed out in is passing out. You're not going to remember the house. You're not going to remember the agent. You're just going to be, waiting for somebody to come and help you, pick you up, and take you into an air-conditioned car. So make sure that if you go into an air-conditioning house, it's air conditioning and it's on. Number 4 on the list would be?
Little cold towel on the forehead.
Little cold towel on the forehead is absolutely right. Now, there are a lot of these do-rags, or there are a lot of ways by which, if you're outside a lot, you stick your hat or your scarf in cold water and you wrap it around your head. These also are good tricks when you're out viewing property. You can always maintain a bucket of ice in the car or some kind of cool liquid that you could have a rag that you can either dab your head or tie around your neck. This is a great way to do it. And the 4th and final one is?
Beer hat.
Stay home. Okay.
Beer hat.
If it's really hot and you've got schedule out there, You don't have to go on these scheduled appointments if it's 100, 110 degrees. And if you have any feeling that you're dehydrated or underhydrated, stay home. Those are our top 5 tips. Daryl, thanks very much for jumping in.
My pleasure.
Okay, and I'm Jeff Barton, your voice in the mortgage industry. We'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.
KCAA. Your NBC Sports Radio update starts now.
3 more to go for a no-no. I'm Jeff Biggs, and a big day today for baseball as right now in Atlanta, Sean Newcomb, the Braves starting pitcher, is 3 outs away from a no-hitter. They're in the bottom of the 8th. The Braves in front of the Dodgers 4-0 in the final game of that series. Keep it locked into NBC Sports Radio and the NBC Sports Radio mobile app. Chipper Jones used to play for the Braves. Today, he's headlining the Class